Now I have a very simple question for you. Trading calendar, just adding an extra leg, you are hedging it on the downside, on the upside as well. Both the hedging is happening at the same time. Hi everybody, welcome to a very special video. Today we are going to cover the calendar spread, one of the most popular strategies, yet there is a lot of confusion around that strategy which we plan to cover today. But before we start, I have to tell you the standard disclaimer that any strategy which you learn, it's for educational purpose. There is no strategy which is holy grail. Option trading contains risk to capital. Now let's talk about the calendar deployment. We're going to deploy the calendar. After that, we're going to do adjustment of it, and not just any other ordinary adjustment. It's going to be unique and very different. Let's learn all about it. So here we are on an option simulator. We've picked the monthly expiry, so we are going on 1st of September around 9:30. So what basically is a calendar is? Calendar is basically you're shorting the strike and then you're longing the strike as well, but you're longing the next month's strike. That is the calendar. Here we are selling at the money. Market is currently 24,650, so we sell the call and we sell the put. And then we go to the next series, which happened to be October. So we go to the next series and then we buy the strike. So let's go to the next series now, which is October. Let's just scroll it, and now we are here. Same time, same quantity. That's how we do the calendar. So now what do? We come where at the money is. We shorted 24,650. Now we look to long 24,700, one strike above and one strike below. So 24,700 is where we're gonna go. So here we go. We look to long this, and then on the put side we shorted this, so now we go one strike down and we long this put. So this has become your quite a conventional calendar spread. The only difference is that we selected different strikes here, one strike up and one strike down. But this is the core fundamental of doing a calendar spread. You can pick the same strike or you can pick the another strike, but the main thing is the quantity remains absolutely same. Now when we do calendar, there are two possibilities which can happen. Point number one is that market can really run in one direction, up or down, and it can really come close to our break even, and then we require to do some adjustment. Or point number two, market will remain where it is. In that situation, there is no adjustment required because this is gonna be a favorable situation for us. That's the only reason why we are doing calendar, right? Now, when you trade into any strategy, two possibility, market will trend or market will not. So here in this example, we're going to have a trending market, of course, right? Because if I show you on a simulator where market is not moving, then what we can see is that things are going in our favor. But in real trading, we do get challenged a lot. And as you know, this channel is for people who want to learn the advanced tricks and techniques. And now what do we see is that one day have gone and then calendar is sort of favorable for us at this point in time. This horizontal line which you see, this is the price of the future at the current day, which is now it is 4th of September. And now what you see, it's drifting towards one side. As soon as we find that our break even is coming close, we look to do some kind of an adjustment. So far it's looking quite fine, and it's absolutely okay. Break even is very far, so we don't need to do any adjustment. We wait for it. 9th have come, now 10th have come, and what do we see is that this is also reduced, and now it is around here. So we do not want to market to cross our break even and then we do our adjustment, because market is roughly 25,000, and what do we see, the upper break even is around 25,144. Also, when you do any kind of a calendar, please make a note that payoff may not be the true representation. The upper or the lower break evens really change, right? Now we have to do some kind of an adjustment. So what do? Step number one is that we open an option chain, and we look to open the option chain which is of September. So we change it here and we come to September, and this is where we are, and we open an option chain, and let's just figure out what exactly we need to do. First thing we got to see is that which strike we sold of the call. We sold 24,650 in this simulator. So what do we look forward to do is we look forward to buy the call, which is around 100 points. So what do we have to do on the put side is the same thing. We go 100 points down and we look to buy a 24,550 put. So let's just buy a call first and then we buy the put. So 750 we are buying. We are buying this, of course, 100 points up because we sold this earlier, and now we're going down and we are buying the put. Now, when we do like this, this is how things look at the moment. Now, a lot of you who are not much experienced in calendar must be looking at this red zone I must tell you, whenever you trade calendar, like I said, payoff is not a true representation. Also, simulator by default sort of assumes that the October option is also going to be reduced drastically, may turn out to be zero. So here, when you trade something like this, let's see what's going to happen with this trade when we move ahead, and what are the other adjustments which probably one can do in this. So let's go slow, step by step, and let's see what is going to happen. And as we are moving ahead with this, what you see is that the payoff is not changing as much as you would expect, as you would like it to be, but it has a huge impact on the situation, the outcome over here. This is happening because you have added an extra layer of protection. You have bought an extra call and you have bought an extra put. And if market is just maybe just hovering around here, as you can see, there is not much happening in the market. As you could see very clearly, you could even go back a little and you could see still we are having a favorable outcome. The reason is very strong, which I'm going to tell you when we are closing this video. So I'm going to tell you all about this. And as you can see now, market is hovering around here. Still, the theta decay is not having much of an impact. Why this is happening, why this exact point is helping us, and a little bit of momentum in the market. And what we see is that this has really turned out to be quite unfavorable for us when we do this. Now, two things. Most of you, when the trade comes out into the favor, most of the traders, what do they do is they look to immediately square off the trade. Now, in the past, I've mentioned this very important trick. When things are in your favor, it's always better to try to adjust in such a way in which you are locking the trade. And if the trade go completely against you, then you should know how to defend as well your particular trade. In this situation, what we see is that if market continue to go bullish, then there is not much of an issue. But maximum trader look to completely exit the trade, because the main fear is that if market go down, then what is going to happen? Then you see a red zone which you would like to take care of. You want to learn the technique. If market go back down from here, how do you lock your trade? Or what if market gives you a gap down? In that situation, how do we look to adjust our trade? So I'm going to tell you now. What do we see is that we open option chain now here, and you will find where at the money put is trading at the moment, and it's around 25,300. That's the spot price. So we look to long this particular put. Now, we are not introducing a lot many legs in this and trying to make it sound like a rocket science. The idea is to make the adjustment very simple, so almost everybody understand it. And if it's easy to understand, that means this can come quite beneficial, and that's the whole point. And now when you see here, what you did is that you added an extra put. But if your view is still bullish, you could see that if market go down. But at the same time, if you were really scared, what if market go bearish? What if market give some kind of a gap down? In that situation, what do you see? Now, if market stay where exactly it is, you could see here this red zone is obviously very small. Now, what are the chances that market just may not move even say 100 points in 10 days? I ask you, what are the odds? For people who are beginner, they may find that they want to see all green everywhere. But I must tell you, in real trading, there is nothing called holy grail. There is nothing called 100%. Nothing. Trading always involves some kind of a risk when you trade into the markets. But just like any business, the main thing is to turn the situation with your adjustment as favorably as you possibly can. You cannot do 100%, but you can do a lot of things. Now, since you're learning here, I want to add few more points. We have improved our calendar, but there are some more points where I see a lot of traders may just miss it. So I want to cover it very quickly. When the India VIX is trading 20 above versus India VIX is trading suppose 10, 11 above, around that, calendar around 10, 11, 12 when the VIX is, because it's a high Vega strategy. So that is a little better condition than trading when the VIX is extremely high. Point number one, when to lock the trade in green zone. This is where maximum traders may do mistakes. So I want to tell you this. Now, if I just remove this particular leg, the leg which we added, what do you see now? If the trade gives you this kind of an output, and now maximum traders will fear the gap down. So the idea when to add an hedge That is when you are getting a favorable outcome. You get the favorable outcome, but at the same time you want to lock it. At the same time, you want to make sure that if market go favorable, it should not have much of an impact. So all these three things, if a person look forward to add an extra put when you do something like this. So locking early is not really advisable, right? Let the trade settle down first of all, and when the trade got settled down, after that, to protect from any kind of a big gap down, then adding a put is a good option. There is no doubt about this. And also remember, payoff point when you trade calendar is very, very important. Like I said, payoff changes, the break even go up and break even go down. If you've been trading markets from quite some time, you will get this idea which I'm giving you in a snap of a finger, right? So make sure that you watch this video again and get the main interesting points which I shared with you. If you trade calendar, if you trade low wicks, then these ideas and techniques can come very handy for you. All right, everybody, thanks for watching, and I wish you all the very best. Take care. Bye-bye.